Welcome to the Celebrity Agent. Today we're going to discuss a few things involving real estate in our community. I have a special guest with me today who is a loan officer. His name is Greg Carpenter. Greg is going to explain a few things about foreclosures. He's going to explain why many people are losing their homes and how to get out of loans if you're caught in the middle of a loan that has high interest rates or high payments. Why has the market gotten to where it is today?
The biggest reason the market's gotten to where it's at today is because a lot of people depended on the appreciation of their home value. As home values continue to go up, it allowed for a lot of the mistakes or for the procedures that are in place now to be oversighted. Unfortunately, when home values slowed down, people that had tapped into the equity too far had no other alternatives. The banks then started realizing that the losses were more significant than what they eventually or normally realized initially. Credit scores were lax, and then when credit scores got even laxer with home equity getting to be such a small crunch, it really forced a problem for everyone involved, sellers, buyers, as lenders as well.
So who should be responsible?
Well, you have to hold the person that makes the decision responsible, and that would be the lenders, the people that loan the money, because they're the people that carry the policies that allow people to buy the homes or to refinance their homes or to sell their homes. Unfortunately, when the lenders allowed the policies to get to a point where it became easy for everyone to do what they did, it ran into a problem that they couldn't foresee. And once home value stopped or just came to a halt and started going backwards, depreciating instead of appreciating, it just caused the lenders to have to reverse their policies, and it put everybody in a difficult bind.
I see. Well, is this the right time to buy, or would you say that a person should wait before they purchase a home, or?
Right time to buy. Wow. You know, a lot of people always say, is this the right time to buy? I always say the right time to buy is whenever you feel that you're ready to buy. At times, the value of homes are going to be less than what they were if you had to wait or if you had gotten early. Interest rates could be higher or less. The requirements could be a little tougher than what they were before. It could be a little easier. Really, the right time to buy is when you feel that you're ready to make that commitment and you realize that no matter what, you have to keep making that mortgage payment on time, because to a lender, that mortgage payment is the most important thing in your life. It's making that payment on time. So when is the right time? It's always the right time, but there are other times that are better or have more advantageous points to it than maybe that particular current moment.
Well, so how could someone become a more attractive buyer?
Things to do to become an attractive buyer. First, you want to make sure that your credit is as good as can possibly, and you've got the highest possible score going into the buying process or when you're refinancing. Even though there are programs out there that will allow you to just get in the door with a marginal credit score, even once you do that, you want to get your credit and you want to increase your credit. You want your credit to continue to go up and up. A lot of people get in and they get in with marginal scores, and then what happens is they get a late on their credit reports, and now they suffer. So when they want to refinance, they can't do anything because they just made it in, and there are no programs available for people with the late within 12 months that want to refinance and they don't have any equity. So you want to make sure your credit is good. You want to make sure that you acquire as much assets as possible, 401ks, get your life insurance that has whole life that you can use for reserves, stocks and bonds, anything like that that will help build an empire for you on paper that will enhance your portfolio and make you a more viable option, a more attractive option to the lender.
Well, you have a lot of people who don't have those things. They don't have stocks, they don't have bonds. What are other options that they could use to raise their credit score, improve their credit?
Well, the first thing a person wants to do if they try to improve their credit is they want to find out what's wrong with their credit. And for that, you need to go to see someone that specializes, that works in that field. Once you diagnose a problem, like anything, let's say a car, until you know what's wrong with your car, you don't know what to do to fix it. Once you diagnose the problem with your credit, you can then go out there and you can address the issue. It may be that you've just got a high debt ratio, which means that you owe more on your credit cards versus your limit of your credit cards. For example, let's say you've got a credit card that's got a $1,000 limit on it and you owe $900 on it. You're at 90% debt to income ratio. What you want to do is you want to lower that debt to income ratio to 30%. So you want to get your credit card down to 300 balance. If you can't get it down to 300 balance because you don't have the cash to pay down the bill, then maybe you want to apply for a credit increase. By getting a credit increase on that limit and now taking that limit up to $3,000, that $900 balance is now a lot less on your debt to income ratio. So there are ways that you can improve your credit without necessarily having the money. Sometimes you want to get like I said, a credit increase, and other times you want to pay it down. There are different trade lines and derogatories that you may want to address that at the time, getting deletions on credit files that are old or need to be paid off, so you can get those deleted. So there are a lot of different things you can do, but you really need to see someone that specializes or works in that field that can help guide you along the right path.
Oh, I see. Well, me being a real estate agent, I've been an agent for over 20 years, and I've dealt with people who are having problems qualifying because either they don't make enough money or their credit score is too low. Now, if there were like a mansion, someone who wanted to buy something, you know, in the upper tier, $500,000 or more, what would you say that they would need to do to qualify to be able to buy something that's more in that price range? Like, I would say maybe $1,000, $1 million, between $1 million and $2 million. Sometimes you'll see people who sometimes they'll pool their money together and they'll buy together in order to be able to buy like something that's more in a better area.
Okay. One of the things you want to do is you want to get people in that are going to be committed to what you're trying to do. So if it takes getting 4 adults on the loan who all are committed to making this happen, and no matter what, making sure they make their payment, that's okay. I've never seen where a lender says, hey, there are too many borrowers applying for this home loan. The lender's not going to turn you down because it takes 4 or 5 of you guys to get into that home. The lender will turn you down because you don't qualify. Whether it's 1 person or 4 person, the lender's going to turn you down because you just don't qualify. If it takes 4 viable adults with income and credit to purchase $1 million home, it makes the lender feel all the more better because he feels like he has more people in the home. That way he has less chances of not getting his payment. I mean, the more the payment is focused or is dependent upon 1 person paying it versus 4 people paying it, your chances always become less, because if something happens to that 1 person, there is no one else to make that payment. If you've got 4 people in the home that are responsible for making that payment, even if something happens to 1 person, you've got a chance of still keeping that payment being going or keeping it afloat.
I have noticed that there are a lot of mansions springing up all over, and the moderate income are beginning to purchase, you know, those types of homes. How is it that they're qualifying to get into those types of homes?
Well, with FHA having raised their limit up to $729,000 in the LA area, it's allowed for people to purchase homes that they wouldn't have been able to purchase 2-3 years ago. An FHA loan requires you to put 3% down. 3% down on a $729,000 home is a lot less than if you had to put down 10% or 20%. You also have programs where they will allow sometimes a seller carry, where the seller can carry the remaining balance. So if you're going to purchase a home that's $1.2 million and FHA is sponsoring $729,000 and the seller's going to carry that remaining note, now you're talking about a balance of $471,000. So then it becomes possible, if you have enough people in that house with income, to purchase this home so that you guys can live your dream model, so that you guys can start buying into the American dream, which is home ownership.
Okay, so that's how they're doing it.
Yes, definitely. Yes, definitely.
Oh, okay.
Creatively finding ways to get things done. Creatively finding ways to get things done. Still within the system, though.
Yeah, because sometimes you'll see larger homes, mansions, or what have you, and you'll see 2 or 3 families living within that home. It's almost similar to a mini hotel or something like that,
exactly.
where they're, you know, leasing or
Yeah, I do believe that in the next 5 to 10 years, you'll see more families living together because they'll have to combat the high prices of the economy, the market at a particular time. With homes going in the range of $500 to $700 to $1 million, it's no longer going to be just a two-person home in that family. You will see a family where you have a brother and a sister and a husband and a wife sharing that home. Or maybe you'll see 3 sisters or 2 brothers and a sister having to share that bill, because just the economic times will determine that you'll have to have more than one person in there to keep making those payments so that everyone can have a quality of life. That's the most important thing. No one wants to make a payment on their home and then not be able to go out on a Friday night or Saturday night or not get their hair done every so often. We all want to live life and still enjoy life. So that's why.
So sometimes you'll see more than just celebrities purchasing mansions. You know, you'll see the moderate income, you know, purchasing mansions, and then they're all living in the same, within the same home.
Yeah. Whenever you've got 2 or 3 families, if you've got multiple income, multiple sources of income coming in, it's possible for you not only to afford a $6,000 payment for 3 people, that means you got $2,000 payment. Now that's a lot more rational if that person in that home, each of them are making $60,000 to $7,000 a piece. So if you've got 3 sets of families, each family is making $70,000 a piece. You've got $210,000 of capital income. You've got a mortgage payment of $6,000. That means we're now splitting that 3 ways, or $2,000 a piece. That's a lot more viable than for one person or one family to try and have an income of $200,000+ and to keep making that payment of $6,000. I mean, we all want to do 2 things. We want to live life, we want to enjoy life. So if it takes having multiple families in the home to get ahead or to sustain a quality of life but also enjoy life, you're going to see a lot more people in the next 5 to 10 years going that route.
Well, what can a person do if they're behind, if they're already behind on their payments and they're caught in one of those loans with the high interest rates and the payments are skyrocketing? What can they do to get out of that?
Well, with today's market, that's a real big problem. With homes foreclosing at a rapidly rising rate, people defaulting on their loans for whatever reason, the mortgage payment has readjusted. They were at $1,500, now it's going to adjust and it's going to go to $2,300. That's becoming a problem. One of the things you want to do is you want to reach out to your lender and say, hey, look, I'm having difficulties making this payments, or I cannot afford this payments. What can we do about it? Because you have to remember this, it costs the lender a lot more to have to foreclose on your house than it does for him to try and work something out with you. So if you call the lender and say, hey, look, let's work something out, the lender is probably more likely to listen or more willing to take on the situation, see what he can do for you, because he wants you in the home. There are different programs, nonprofit programs, that will work for you to help your situation if it's gotten to be very bad, or if it's deteriorated almost to where you're going to lose your home. And then you can always talk to your local real estate agent or loan officer, someone, and I'm sure they can not only help you, but get your situation rectified so that you can go back to living your life and stop being stressed out or worried about if you're going to be evicted or put out of your house.
Well, does it actually work? They have programs where they say that the seller will pay the down payment. Does the seller actually pay all of the down payment or some of the down payment, or how does that work?
Well, the biggest thing is this, is that the seller can only pay what's allowed by the lender being the bank. Some banks will allow 3% closing costs contributed by a seller. There are some banks, which are a lot fewer now, that allow up to 6%. Most cases, the standard procedure is 3%. So you figure 3% on a $300,000 house means that the seller can only contribute $9,000. So even if the seller says, I'm going to give you $20,000 for your down payment, the lender will only allow you to use $9,000 of that anyway. So yes, the seller can contribute, but it all depends on what the price of the home is, just how much the seller can contribute, because there's a maximum amount the seller can contribute to your purchase in that home. You need to be prepared to finance at least up to 5%, regardless of whether or not you use a total 5% or not. Whatever the cost of the house is, if you've got 5% put away in reserves or you have it available, then you're going to get yourself a house somehow, some way.
Well, see, what's happening now is I'm noticing that they're putting mansions in cities, you know, that are the inner city. Maybe you may find a mansion spring up in Gardena or in Compton or in LA.
Yes.
What's going to happen to the value of that mansion in, say, like 3 years from now? Will maintain its value? Will it be easy to get financing? Say, for instance, if that owner decides to refinance or if he decides to sell, what happens with the appraisal? Will they be able to get a loan on that if someone decides to purchase it, or how does that?
Okay, well, what happens is that with homes, anytime you're appraising the value of home, the homes have to have like similarities. So if you put a mansion, or if you've got a house that's of different size than the house that around it, then they have to go somewhere else or the most closest surrounding to determine what the value of the home is. Because if you've got a 3-story mansion and then all the other houses are 1 story, there's no way you can get the same value for the 3-story that you're going to get for the 1 story. So the appraiser would have to go out elsewhere to get the value. Value is determined about the market. The more people that are in homes, the less foreclosures, the more tidier, the more nicer, the more upgrades the homes are, the more value the homes are going to keep. A lot of people have homes, once they pay them off, they don't do anything to the home. They don't upgrade the kitchen, they don't repaint it, they don't redo the roof, they don't enhance it all. So therefore value is going to stand still. The more money you put into your house, the more value you're going to get out of your house, which in turn will help your neighbor. So when your neighbor goes to sell his house now, he'll get what he's looking for because you've done something to your house. As everybody helps each other, it keeps the value of homes at a nice incline so that everyone can benefit the positive from it.
Oh, I see. Well, exactly what year? What year did the bad loans start? I wouldn't say the bad loans. At what year did the subprime loans begin?
In 2002. That's when subprime loans really hit the market. It gave people an opportunity to invest in home ownership that otherwise couldn't afford. With you being able to do what's called an 80-20 loan, where the lender financed the first 80% and then the other 20% was financed on a second loan, it gave you a chance to not have to reach into your pocket or have to have as much capital investment in order to purchase that home. There was nothing wrong with the subprime loan. The biggest problem was that the lenders kept banking on values appreciating, and the owner of the home didn't maintain their credit. Once they got late on that mortgage payment and that value of home stopped appreciating, it became a problem. It was nothing that could be worked out. So the subprime loan, although it had its negative drawback, was beneficial to a lot of people because it gave them a chance at home ownership that they may not have ever gotten.
Well, how long do you think we're going to have to deal with this market, the recession, or the loans, the foreclosures?
I see a lot of people, a lot of experts that predict that, at the end of this year, the beginning of next year, after the presidential election, they are coming out with an alternative lending program later on this year. It's not going to be subprime, but it's going to be something along the lines of what subprime was. It'll have different guidelines, so that'll help the market because it'll get people into homes or give people a chance to refinance homes that right now can't get it done because of the rules and regulations. I think with homes starting, the value of homes depreciating, giving people a chance that didn't own homes a chance to buy at a more reasonable price. For example, Corona, the average home 5 years ago was about $500,000, almost $600,000. Now you could get that same home for about $250,000, $300,000. So now people have a chance to afford those homes that they once weren't. So with some other programs coming out and with the value of homes kind of getting back to a more normal value, I'd say probably in the next 9 to 12 months, you'll definitely see a change in things and people start feeling a little bit better about the economy.
Right. Well, they're saying that Riverside was hit the worst. Yeah,
definitely. Riverside was hard hit. The Compton area was hard hit because you had homes.
They said Compton?
Oh yeah, Compton, because you had homes in Compton. The average price of a home in Compton was $400,000. $400 going up to $450,000. Just 2 years ago. So when those prices hit, it didn't leave much room. And then once value started deteriorating, those people couldn't sell those homes, so they went back to what they were before. It went from $450,000 back down to $300,000, which is about what it's at right now. Riverside, they were developing a lot of homes. They overbuilt. You'll see a lot of lenders, developers that have built homes, and now they're slashing because they overbuilt, or they're even having to cut back, being aggressive in building because they overbuilt or they got too many licenses to build homes, and now they don't have the people there for them. So definitely, Riverside, Compton, certain areas were hit a little bit harder than others, but things will get back to being a little bit better for the seller as well as the buyer.
Will things get worse, or?
Of course, you know what, things could always get worse, but
Oh.
I believe in the optimistic side of life. I believe that the worst has come to pass. The market has taken the jolt that it's going to take. It's now bottoming out, which means that it's developing some legs underneath it. You know, with anything, you've got to be able to stand firm, and that now that the legs are starting to stand up underneath it, you'll see a market that'll start getting healthier, more sprier. You'll see more people feeling better about the market, and you'll see more lenders really looking forward to bigger and better things now that a lot of the things have been cleared up and they know exactly what to deal with and how to handle things now.
Okay, well, take, for instance, okay, pretend that I'm a senior citizen. I want to buy a home. I have
Yes.
money in the bank, good credit, but I don't have a job. What can I do to purchase a home?
For senior citizens, they have certain programs out there, different programs, particularly for people that are retired. Maybe they're drawing a monthly income of some sort. There are different ways to help people depending on their situation, senior citizens in particular. There are different programs. What you want to do is you want to talk to a loan officer or even a real estate agent and find out from them what's the best route to go, because everyone's situation is different. So once you talk to them, they'll let you know exactly what can or can't be done for you, or what's the best way to handle a situation. And it also depends on what price you're looking to get. I mean, the higher the price, the more difficult you may make the situation. So you may want to be a little more realistic in what you're looking at to make your situation a little bit easier to obtain.
Okay, I'm a pastor of a church. I don't have any W-2s.
Okay.
But there's a church that I would like to buy. How can I do it?
Pastor would probably have to go through the church that he's pastoring and allow that church to purchase a home for him.
Maybe the
In
board
that
of
case,
directors.
or the board,
or,
exactly. You would have to go through that process, because you may not be able to. Maybe you're pastoring for the church and you're trying to help the church get back on its feet, so you're not drawing a stipend yourself or an income of some sort. So they would definitely have to go through the board of directors to where they would put up and help put it in your name or get in your name so that you could make the purchase possible. But there are different ways to get things done. Like I said, you really would have to talk to a qualified loan officer or even a real estate agent, someone that could better direct you in that particular manner.
Okay. Well, thanks very much,
No,
Greg.
thank you very much.
Thanks
And you
for
have a
being on
nice
the
day.
show. Thank you for watching Celebrity Agent. I am Carol. Tune in next week.